We live in a world where AI and business in eCom and online business is changing so fast. The onus is now on the seller to really understand what their business is, what their needs are, what money do you need, what are you using it for, when does your cash flow go positive that you can repay it, how much is your profitability so you can understand how much APR you can actually cover. What are the real costs of capital? What are the hidden costs or risks that sellers overlook when selecting their financing? Welcome everyone. Today we're going to be spending some time with Blaise, who is the founder of both Minimal Brands and an exciting new venture called DasTurbodash. We're going to be focusing on, specifically funding today. So we're going to be talking about Blaise's new project with DasTurbodash and how he's helping e-com sellers and CPG sellers fund their growth. Blaise, welcome and thanks for giving us your time today.
Hi guys. Hello Richard. Good to be here.
Great. Before we get stuck into making wiser decisions about funding your growth, can you give us a bit of background about how you got to where you are today and a bit of the journey of how DasTurbodash came about?
Yeah, sure. So, like you said, I'm a founder of Minimal Brands. So we are in Minimal Brands. We're a boutique, I would say, e-commerce accelerator, something that is quite popular in the States. The bigger players are Pattern, like we everyone know. But I identified some time ago a niche in Europe where we are based as Minimal Brands, and we started to become boutique e-commerce accelerator for brands, for brand owners, for the producers in Europe, and going with the natural growth of e-commerce business, we were, I think it was 1.5 years ago, we were stuck with growth, and like most of the e-commerce businesses, we needed growth capital at some point. And I started to looking for the capital, and I knew that there were some providers that are giving something that it's called alternative financing dedicated for e-commerce, which was not that popular in Europe back in the day. Now it is, because as we all know, traditional banks and e-commerce doesn't always speak to each other because it's a very, very specific niche. What we realized that there are like more than 50 providers on the market with more than 80 or 90 products with different names, different purposes, different terms, and the main problem was that they were scattered across the market. Basically, it was really, really hard to even identify them and to find them and then to compare the options and then to compare the products and go through all the registration processes, because we have 50 providers. So we have 50 registration processes, even to verify if we are eligible for this product in terms of the geography, the revenue, and other parameters. So we figured out with my business partner, Thomas, that it would be great to have such a tool when I register just once and I have all the options that I have on the table are in front of me, so I can narrow the looking for the capital from weeks, because it was weeks. It was really 3 weeks to find all of those, to go through the registration processes, and then to compare even the products in my own Excel, what they're all about, because this was something that was quite new to us. And this is how the idea for the project DasTurbodash came into life. So DasTurbodash, it's now a marketplace for financing options strictly for the e-commerce businesses, streamlining and democratizing the process of reaching for this alternative capital for e-commerce. And like you said, we are still an early stage startup, but we launched in the US and in the UK at the end of 2024, and right now we're available in the UK and in the US and also in France, and expanding right now to other countries.
I'm super excited about what you're doing, because of what I've seen with our clients across our different businesses and having looked for funding for some of my shops, right? My Shopify and Amazon stores. I love brands that are being built on a solution that you needed for yourself as a seller, right? So what you're doing is nice and unique. Where the seller comes in, what would be the kind of ideal seller that you work with, seller founder? What size business would, or what characteristics of a business would be the best type of fit that you would envisage getting the most value from TurboDash?
So the main idea behind it is to because on the one hand we have multiple offers for like a one size doesn't fit all. This is what we all know, and this is the same in terms of lending. But the user, the e-commerce owner, doesn't know if the provider X would give him the X amount of money. But for example, their eligibility starts from 500,000 per year. And for example, the user with 5K a month, they will apply to a company which is only for the 8 or 9 figure sellers. So what our idea was at the beginning, and it's still to this day, it's to provide the value to all types of the e-commerce sellers, because both of them need to narrow their field of looking for capital. So if we are 5K seller and if we are 5 million seller annually, they all will find the answers for this crucial question: what's on the table for them? Of course, this is where the journey starts. But from this first promise that we're going to show you what's there for you, it's for all kind of sellers. Of course, the very, very mature sellers, like 100 million a year plus, they have their own resources to do what TurboDash does. But for example, till this cap of 20 million a year, I think they will all find it valuable for them to have quick access to the answer, what's on the table for them in terms of e-commerce financing.
I like that. So if we go down to kind of our first point that we're going to get into today, I'm always engaged with sellers about when they should actually consider external financing, right? So, I'm a big fan of people first trying to really maximize their working capital. So, are they getting the best payment terms possible from their suppliers? Are they getting the quickest payouts from their customers possible? Obviously, if you're a CPG brand and getting paid in 90 or 120 days, you've got some challenges. And if you're buying product from China, hopefully not right now with the tariff, but chances are you're putting down a 30 to 50% deposit, possibly 3 months before you get your product, right?
That's right.
But working through that aspect, as well as maybe advertising needs, etc. Silly things like will Meta give you a 45-day account, for instance, right? From your perspective and experience, based on being in this industry before you started TurboDash, when's the right time for people to consider using external finance?
When you can, for me, the answer is simple. Apart from what you said, that you need to have, and I'm sure we're gonna reach this point to be super organized internally, but to even briefly being able to identify your cash flow. Because if you can identify, it's not even about the margin at the end. It's not about some more sophisticated numbers, but how much cash flow do you effectively have at the end of the month? So then you're able to even go through the options and see, like with this simple calculation, if this is something, if it's going to cost me, for example, this financial product is going to cost me $1,000 per month. So if I have a positive cash flow of $5,000, I can use it. But if not, I need to figure it out the other way. So I think this is the most, we're trying to be cash flow oriented, because this is for all kind of CPG businesses this is most crucial because we have those hundreds of thousands of transactions, and it's sometimes even too hard to identify how much do we have at the end of the month. So to be as simple, as streamlined as possible, I think if you know how much cash flow do you have, you can consider and like look for the options. And of course, this is only where the journey starts, because in the perfect scenario, in my opinion, would be if you have some data of your and you can be calculated eternally somehow to some point. You can reach for the options and see what's available, and then you can make the order internally, for example, to fix all other metrics, and then you can reach for those options again, and then you will see the difference between the more data you have about your own business, the better options you're gonna get. So I think you need to have those first metrics, and the first metric for us would be the cash flow at the end of the month, because you know what you can afford.
And also being able to project that cash flow forward 6 months, even though you're at best you're guessing, right? Like what are those cash flows? Whether it's going to be the same or whether you've got some cyclical tendencies. I suppose it also helps to understand then in that model by looking at the terms of multiple different loans. If you've got to repay loan A back over 6 months, but you only get your inventory in month 5, therefore you're probably not going to be able to repay that loan out of cash flows from selling. So therefore you need to look at loans that will give you 12 months worth of repayment terms, for instance. So modeling that cash flow, I agree, is absolutely important.
And the second that I would add, because I think this is something that we usually forget about. The financial products, they are designed for the predictable parts of businesses. Because if you have some predictable part, something that you can do the projection, just like you said, and you can estimate the 6-12 months of some part, if it's advertising, inventory purchasing, the sales of some portfolios that you have or some shops. And this is like a quite big probability that it's going to work. So those financial products, especially alternative ones, in terms of alternative financing, then you can consider them, because this is not a blackjack. They won't help you to do the thing that you don't know how to do. It can, it can push you in the right direction, but it can push you in the wrong direction as well.
I think we've both seen those businesses which just rush to take out any loan today, even though it's not matching when they're going to get the returns back in, right? And then 3 months down the line, they're rushing to get another loan because now they have to repay the loan that they first had. So without that cash flow model, I agree, that's the starting point. I think that's some really wise advice. Getting that right is not easy, right? Actually doing a cash flow, chances are you're an e-com seller, you're probably really good at marketing, but you might not yet have comfort doing a cash flow or even having a basic income statement and balance sheet understanding to build your cash flow from. So it's a skill set that you need to take on as a founder before you go off and just start taking funding to solve today's problems.
One thing that it's, I think, worth to add over here, it's try as early as possible to reach for the options, to be prepared to take them when you actually need them. Because just like you said, that people are rushing out to take what's on the table immediately for yesterday. But it's all about that you should choose the right product, not the product should choose you the other way, because it's going to be an unhealthy relationship. You need to choose that's why we have 50 lenders. That's why we have 80 types of product, because every particular situation is different. And you need to know what is your situation to be able to choose the right option. And TurboDash is designed to help you with this process.
Yeah, I like that, because what you're doing is, it's a bit like going into some type of relationship, right? This is not a situation of love the one you're with. You want to find a perfect checklist based on what your cash flow requires. Then you can match out all the different options that you get from TurboDash and go which one selects or matches best with your needs, versus what I've seen majority of sellers doing when they're growing, when they had 500,000, 1 million in sales, and they're starting to really be short on cash, they literally they'll take the first loan offer that comes in, and they haven't thought about their cash flow. So I think if we got to lay out the real value, is the ability to match the correct loan terms, not just fees, but the repayment terms with your cash flow needs. But you need to understand your cash flow needs first, right? That's wise.
That's
Like
right. The simplest one, if you're going to write in Excel your projected positive, negative cash flow for the next 12 months from this predictable part of your business, and what's the space for the additional product, right? Because you need to earn for this product. This is not something that someone will give you for free. It's also a tool, and it's usually an expensive tool, and you need to use it wisely.
Yeah. So Blaise, we're kind of starting to see a picture where we've got our cash flow modeled out on a spreadsheet, month by month, for whatever period we're looking at. What are the real costs of capital? What are the hidden costs or risks that sellers overlook when selecting their financing?
Because there's plenty of different types of fees and interests, and right now it's really hard to decode what they are all about. Because even if we see, for example, in terms of the fees, something may look very, very, very simple. So, for example, we're going to take 1% of your daily sales. And it looks right. It looks small and quite convenient, but it can be killing. It can be a very fast track to lay down your business. So the first thing that I think we don't do it as e-commerce sellers, is we do not consider that the fees and the APR it's one thing, but we need to multiply this APR. The APR is, of course, it's very unified metric, but the fees during a period of time. So, for example, if we have if we're going to take the same offer with the same, I would say, price for 3 months, it's going to be completely different that we're going to take it, for example, for the 6 months. So we need to add up and to do the prognosis and forecast ourselves what the actual cost will be, because the fees and the APR, the fees, the fees needs to be calculated for our own case. It's not that that something is written over there in the offer and it looks like super unified. It needs to be considered by our own situation, by the period that we're going to need it, and needs to be done according to the cash flow prognosis that we discussed before.
So let's understand, for the non-finance orientated, what do you mean by APR? Can we give it like a little example of that?
So it's an average percentage rate as a yearly cost of capital. So this is the difference between traditional banking and the alternative financing. That as the alternative financing are not usually a banking product, because this is like fintechs that's selling you a financial para-financing product. So they are not obliged to use the term of APR. They can give you a fixed fee, like a price tag, for a product that they're selling. So if we're going to look at traditional banking, we have the APR. So it's very easy to compare one APR to other APR. And then in terms of fees, it's much harder, because the fees is related to something of your daily sale, monthly sale, of the value of your inventory or other stuff. So the APR is going to be always the same, like in terms of understanding the APR. But in terms of the fees, it's worth to break down the fee and adjust it to your own situation and the amount that you're going to take, and your, for example, the projection of your daily or weekly or monthly sales. And the APR, it's just strict the cost of capital in time in terms of annual annual cost of the capital.
So a good example, I just want to try and break it down practically a little bit. So I often see, I don't want to name lenders because they all do something similar, but let's say lender A comes along and says, I'll give you 100,000, you're going to repay me 106,000. So there's a 6,000 fee. And you're going to pay a percentage of sales back. You look at that and go, well, I think I'm going to land up paying that 10% of sales or whatever it is back in 3 months. So what I often get is the seller will talk to me and go, oh, my cost of capital is only 6% because it's 6,000 over 100. But no, that's not correct, right? Your APR on that, if you're paying back the 6,000, i.e. the 6% in 3 months, in 1 quarter, the effective annual interest rate is 6% times 4 quarters, being 24%, right? So if you're comparing that loan at 6% with an APR, an annualized rate of 24, and you compare that to your SBA loan that you could get in your personal name at 12%, it's twice as expensive. You then weigh up, well, the SBA loan has some personal surety, this loan doesn't, and there's risk and return, right? But that seems to be the way that people are getting caught out. They think they're getting a great deal at 6%. Well, actually, it's a 24 or a 30% or a 38% annualized APR. So would you say that one way of analyzing this is to calculate how quickly that total cost of capital or fee will be paid back in total and gross it up to a year, right? It's not an exact science, I know that, but that gives you some type of way to compare apples and apples, right?
That's right. The comparing that, this is what I wanted to say. Like, we need to make somehow, we are trying to assist the sellers to do that, to compare the apples to apples, because at the end, it's a capital. Like, we can name it differently, but it's a capital. And this is in our perfect world, in our perfect, the future version of TurboDash, we will try what we are doing with our R&D team right now. It's to be able to break down your forecast in the next 12 months and to look at it at the point of cash flow, just like it's a simple equation. And then you're comparing the apples to apples. Doesn't matter if it's a fee, if it's an interest, and it's an APR or whatever it is. You're going to see how it's going to affect you. So what is going to be the effective cost at the end of the month? Because it's like you said, some of us just starting this journey, some of us have CFOs, but at the end, the cash flow is king, like, especially in the CPG business, right?
Absolutely. And it's not just about cost of capital, right? So one loan that might be an APR effective 28% versus 24%, but what you mentioned earlier is also the time in which you have to repay it. So yes. One of them might go, oh, it's a smoothed out payment over 12 months. Or it might be 10% of sales, which you figure out and calculate might be full repayment in 3 months. You want to match that. I'm sticking to this. What you spoke about is your underlying operating cash flow, right? So if your inventory cycle is 6 to 8 months, a 3-month loan, even at a lower APR, is probably not going to be useful because you haven't turned the inventory. Whereas if you took maybe a slightly higher APR that gave you 12 months of repayment, that would match your cash flow. So it's not as... I personally have tended towards only looking at the APR, whereas what you're saying is we must also look at the correct match of the underlying cash flows. And I really like that. That kind of dawned on me.
That's right. The other thing is, especially, for example, for wholesale businesses where the margin is lower, or those types of e-commerce is like, I don't know, fashion. Maybe not fashion is not a good example, but for example, supplements, because there's like the market is so packed and the margins are quite low. Because we need to invest in advertising. We have very, very big competition on the market. So, for example, if some product will take 10 or 15% of our not profit, but revenue each day or each month, we need to consider that this might be below our margin. So we need to consider that this financial product would need to allow us to grow so much that if we're going to get rid of this product, we're going to keep this tendency and we're going to return to our margin. That's why it's very, very risky to take what's on the table, because we are not considering the fact that 10% of revenue, it's not the 10% of our margin. It's the 10% of the total revenue, and we need to cover all the other costs as well.
Yeah, that makes a lot of sense. Because I tend to think about all this revenue growth financing always for inventory, but you might be spending it on advertising, you might be spending it on a new country or region launch. There's a whole bunch of reasons that you could be taking this this funding, right? What I really like about what you're doing is for a normal seller to go and work through 50 offers or even do 50 applications or 20 applications would be so time consuming that they would almost stop running their business for a month, right? We've both done that, right? One application can take you hours. Now you go do 20 or 30 of them. So by making that easily, I think you used the word democratized earlier. I think that's a really good term for this. The wisdom then comes in, because now it's not just a convenience or a take the first ones that are available because you've out of time. The responsibility of the seller then is to get either the skill set themselves or hire the skill set to be able to model the cash flows for the next 12, 24 months, and then analyze both the APR costing of this capital, but also the timing in which it needs to be repaid, and then match that against your operating cash flow shortfalls or excess, right? So yeah, I really like that. That's really useful. Yeah.
I would add something else as well, because probably we're going to get into this point later on, but we have at least 10 types of different financial products, and they're meeting different needs. So for example, for advertising, we can have totally different product. For invoice factoring, we can have totally different product. For reverse factoring, which is also really, really great because you don't need to pay for your costs, even sometimes for employees or for the rent or other stuff upfront, but you can split that into 12 months payments. So there's like so many different products that can meet your actual needs, and the thing is that you can combine them, because you can take something else for advertising. You can have a line of credit, and you can have the invoice factoring. We call it internally, we call it a fin stack, like an e-commerce fin stack, because you can really combine them to your needs. And I think this is the crucial part. If you're going to use it as a tool, it can really leverage you up.
Yeah, I like that. I saw that with someone I was working with before, where they might have used, say, for instance, Wayflyer or Sellerify for their inventory, but Clearco, for instance, has a whole bunch of rebates on their costs if you're using marketing partners. So their Amazon ads and Facebook ads reduce the cost of capital if you're paying. So you can really structure that. I like that approach. But again, it comes down to the time to go and do all the applications and the analysis. And I think that's what you're onto here. That's very special, is you're now democratizing that and making, a normal seller who doesn't have 50 hours to plow into this, they have the access to look at 20 different offers, right? And understand that. So that's really, really valuable. I would love to go into a little bit more around this concept of profitability versus growth. And we spoke about cash flows, but we want to talk about balancing funding with profitability goals, because sellers have a difficult business to run, don't they? Right? Like you can't, it's not like running a finance firm or a marketing agency where you just, you increase prices and increase number of clients. Because here you've got to invest in inventory a couple of months before you increase sales. And that usually leaves a big funding. And let's call a spade, advertising doesn't just get turned on, right? You're going to spend on ads for a month, 2 months, 3 months before you get the actual funnel working. All of that needs to be funded. Have you got any wisdom or thoughts for sellers who are battling to get this balance between profitability goals and funding, figuring that out?
I would say start small. So I think the bookkeeping, the having the books in line with all the requirements of the lenders and having the data right, it's a lifelong process. So what I would do is I would identify the cheapest product with the best leverage as a start. So first, of course, the strategy, like the strategy of the business. So how we can grow, where are we going? The second one is to have the books in order and to understand the cash flow, what the metrics that we already have. And then, for example, identifying the first product that would give us leverage, because maybe we are not eligible for the best and the cheapest line of credit that will allow us to have 500K. If we're gonna need it, we're gonna use it. This is a dream scenario for most of the brands. So I have like something is waiting for me over there, and I'm not paying for it. I'm gonna pay when I'm gonna use it. But till we get to this point, we need to grow and we need to be profitable. So what I would advise, what I would do, is to start small and identify those products and those aspects. Like, for example, invoice factoring that will allow us to have a bigger cash flow. The bigger cash flow would allow us to negotiate better terms with the suppliers. So we're gonna have the better margin. The better margin we have, the more products are gonna be available for us. So I would do it like always in tandem. And not trying to overdo this financing stuff. So start small, look for the tiniest leverage, use the product, make the metrics better, make the profitability better, make the margins better, optimize the costs, and then start over. So we can start over and start over and start over till we get to the point where the financing is going to be like the right financing on the right time, with the right cost is going to be available for us at any time.
Yeah. And what I think the word here is patience, right? Everyone wants to grow their business to 10 million in the first year. I've seen a couple of people do that, but I've also seen a lot of them get to 5 million and then go bankrupt, right? Mm-hmm. Because they can't keep up. So just practically, in terms of a broader perspective on this thing, most sellers start off, they put a bit of their own capital in. They then, they get a couple of credit cards going because you get the first 60 days interest free. But when those credit cards kick in, it starts getting expensive. Then you've generally got some type of inventory purchase or a new sales channel that you need to invest in. And that's where these growth capital kind of options are really important. And I see two types there. The guy who's selling on Shopify or Amazon, and there's small consumer purchases are growing at high volume, versus the more CPG type brand where they get a big new retailer who's got a huge order. And there's two different types of financing there, right? The one might be a 6-month growth capital or revenue factored loan, and the one could be an invoice factoring, right? So your first purchase order from the big retailer gets, you got 90 days or 120 days before they pay you. You give 10% of the revenue away to an invoice factoring, and your cash flows work. At that point, it's quite interesting because 5 years ago, there were these SBA loans which were available. And although you kind of signed personal surety, you didn't really have a lot of personal risk. And the cost of capital, some of those loans that I saw were guys getting 800 grand, 10-year repayment terms, 3% interest, like just off the chart. To be clear, that world doesn't exist anymore, right? Now, even those SBA loans in America are 12, 14% APR, and you've signed over some personal surety. So that's again, looking at the different options and understanding. And what I think we're adding in there is, it's not just about cost of capital, it's not just about timing of the cash flows, but there's also some type of personal risk or surety. If you want to bring down the cost of capital, you're generally giving some type of surety, right? But at some point, you're going to get to a size where you're able to do more asset back. Like the business, the inventory and the receivables on the business are enough surety. And that will also then bring down cost of capital, give you longer repayment terms, etc. But there's this no man's land where you're going from 500,000 to 5 million, where you're going to have to get growth capital. So would you say me calling this growth capital being loans that are primarily backed by your revenue? Like someone's looking at your Shopify, Amazon sales, or you've got a big box retailer with a whole bunch of purchase orders. Someone's going, that's enough surety for me. And they kind of say, if you don't pay me, I'm taking a piece of that every day or every week. That growth capital is where people come short. Are you happy with the term growth capital for that size and that type of loan?
Yeah, I would say it's a growth capital, definitely. But again, I think the misconception on the market is that we as users of those alternative financing options, we're identify all those options as like traditional loans. They are not traditional loans. And for example, this is like the traditional loan is like you're investing in a new venture that have some like the probability of and the period of investment are significant. And we are like, this is a misconception of like the wrong thinking about it. This is completely different product. And this growth capital, it's a tool. You need to use it like, for example, an ad spend. This is high risk, very consuming. The burn rate is huge. So I would consider this more into those tools like advertising or like leveraging the business on this tool side than the traditional understanding of loans and capital. Because this, for me, the traditional loans is R&D. This is traditional. And if you're gonna see how it works, and I think there's the point that you need to have 10 or 20% of the loan on your bank account to get a loan. And if you're going to think this way in terms of the growth capital, you need to, in my opinion, double that. So if I'm taking 500K, for example, a quite expensive product, but it's worth to take, I need to be secured for at least, for example, 200 or even 150. And then it's a healthy relationship to this growth capital because you're leveraging but being secure. Not if you're like minus 200 and you're taking another 500. It's like it's just not going to work. It's like it's a lottery. It's not wise growth. So I think we need to understand that this is the growth capital. It's something else in terms of long-term investment, R&D, new projects, and other perspective, and rapid movements, short-term plans, like quarter plans, half-year plans. So we need to have this predictability. We need to have the books in order. We need to know if we can afford it, and we need to be in the best option. We need to be secured as well. So we need to remember that. That's why they invented that you need to have some money in the forefront, because you need to be secured. You won't. It won't fix your problem. It can only get worse if you're going in the wrong direction. It can push you in the wrong direction even more.
Yeah, I think that's really important. I've seen a lot of that. This is not a Hail Mary to get you out of this week's cash flow crisis. If you've got a product that's not profitable, if you haven't calculated your margins correctly, yeah, you might be broke today, but you're going to stay broke. If you take out growth capital, it's going to be even worse, right? So this only works if you've got a profitable business that you're trying to scale and you match the loan to the correct timing. Then this is a very powerful tool. But if you're using this as a Hail Mary because you've actually not got a profitable business, this is just going to make everything 10 times worse. You're never going to repay this debt. You're going to take further loans to repay
It's
this
going to
loan.
spiral. Yeah.
Exactly. So this is the way to level up. If you've got a business that's a sales channel that's working, marketing that's working, and you've got the correct margins. If
That's
you're
right.
only making a 5% margin on something, well, then take a loan that's going to have a 24% cost of capital, because you're going to be negative 17%, right?
This is the thing, and I think over here, the wise words is going to be, if you can't afford those products and something is going wrong with your business, try to identify the problems and win down a little bit. So, for example, you have 200 SKUs. So focus on those SKUs, cut them in half, increase the profitability, increase your metrics, and then go for the growth capital, not the other way around, because it's going to be more messy. So it needs to be very clear, very streamlined to be able to leverage from the growth capital.
Would it be fair to say that if you've got a business that you're thinking is going to grow, maybe slow down for a second and say, well, if we didn't grow, if we stayed at the same revenue that we are today, are we profitable? And are we profitable at 15, 20, 30% net profit? If not, well, funding's not going to solve your problem, right? You've got to make sure your margins are there so that you grow profitably. Otherwise, all you're doing is, working for the loan company, right? Because you're going to keep growing your revenue and you're going to pay all of that profit across. This is not cheap capital. It's a very powerful tool that's very easily accessible if you are growing.
Yes.
But if you're not profitable, what are you doing, right?
That's why, Rich, like we said at the very beginning, the safest way, if you're going to look at your predictable cash flow and you're going to add the cost of the capital and you're still going to be cash flow positive, you can use it. Yeah. If not, this is you need to take this as an investment, as a cost, and you need to be profitable from the day on you're considering that, because it won't help you the other way.
Yeah. And you've got to be realistic that you can actually repay that loan. Yeah. Oh man, how many times, I'm sure you've seen quite a few sellers, I've seen a lot of them, where they have managed to 10x their business, but now they owe so much that they're never going to repay it. There's not enough profits to repay those inventory loans or marketing loans. So
we call it, like in loans, imposter syndrome. This is like you're lying to yourself that something will, something will change. It won't change because it's, for example, you won't reach higher margin, for example, than 35% of such products, and you're like lying to yourself that something is going to be different. But we need to get rid of this imposter syndrome in terms of using the growth capital, for sure.
Yeah, I really like that. I'm going to keep that term. It's a good way to talk about it, imposter syndrome. We've covered a real kind of gold mine of wise decision making here. We live in a world where AI and all of this kind of business in eCom and online business is changing so fast. I would love to hear your thoughts on where e-commerce, and specifically funding and growth financing for e-commerce, is going in this new world of AI and the future generations.
Sure. In our opinion, in my personal point of view, is that as we can see, the alternative market of capital products is growing significantly. So there's like more and more. So it shows us in which direction we're going. And the second thing is that even the traditional financial institutions, they are creating dedicated products for every sector. So we can expect that right now we have 50, like I say, for example, 50 providers and 80 products. In the next 3 years, it can be like triple the digit. So imagine going through all those options and all those new options that are appearing dedicated, for example, for the e-commerce business. And as we see, like e-commerce is growing, and it's going to grow and grow and grow for the next decades. So the thing is that the main thing is over here to be ready in terms of your data, because as they say right now in the era of AI, the data is new gold. But the better your data is, like the gold is more pure, and you can make the best out of it, right? So first is to be prepared for the era of AI and the future of financing is to have the data in order. The better data you have, the better organized you are, is the better to fulfill your future capital needs. And the second thing, it's using something to streamline and to short the process of looking for funding and actually find something that really matches your needs. And so this takes us to your needs. So you need to really know your needs, because the capital is very, very, very broad definition. So like we just mentioned during the podcast, you can have capital for variety of different needs and pains and the possibilities. So you need to have your own strategy. You need to have your data right, and you need to know what you're looking for, basically.
Blaise, this has been such an interesting insight for myself specifically. I've fallen into the trap of just calculating APRs, but what you're doing with TurboDash is you're making the seller able to not just have to take what they're offered. We're turning the power around, right? And because there's so many sellers, there's also so many providers of finance now. If I sum up what I understand is the future is going to be, what are your specific needs? If you don't know that, you can't go, now you can just go and kind of pick from this marketplace of all these different providers. So the onus is now on the seller to really understand what their business is, what their needs are, and therefore match themselves to the correct lender. It's the first time since I've been in this industry that that's now becoming a real possibility. Before, you just took, you applied to 2 or 3 loans and you took what you were offered, and you got lucky or you didn't. So it's super exciting. If we look at where TurboDash is going, we've spoken a lot about that, and I think you've got probably a decade of evolution as this grows, and you're the first to market here. For sellers who want to work with you and with TurboDash to start accessing more than just 2 or 3 options, how do they go about doing that?
So it's super easy to start, and I would really advise to do that even as just an experience exercise for the business. You can just go to TurboDash, fill the form with your needs, with the short details about your project, about your company, and see what's on the table for you at this very point, just to be aware of the scale. So we built TurboDash in this one-to-many approach, because imagine that this is super powerful tool, and it's 1 to 80, no, not 1 to 5. And you have access to all of those, but you need to know what to pick, and you need to know what would be your needs. And I think if you're going to go through this experience and just look what's on the table for you, you can book a discovery call with us, which I strongly recommend. We can show you how the platform works, and we can show you some things that you may not know about the products yet. And then you can go back and think about your strategy, because it can also be inspiring. Okay, so I can fund this, for example, on those terms. And this opens new boxes in the understanding of the e-commerce business. So, okay, I can leverage over here. I can leverage over here. And out of that, you can build a strategy how to use those financial tools wisely, to use it as your advantages, again, against the market, against your competition, because it's, in our opinion, and what we're looking at right now, we found, this is a fun fact, that we found a study that 71% of e-commerce sellers in the US already using or used alternative financing. So, and the awareness level of the fact that there are more than 10 of providers, it's super low. So imagine how big is this field to be fulfilled in terms of optimization of this process, of leveraging this up. So I think this is something for the listeners to just understand how many things can be done in this field still, and it's going to grow, and the offer is going to be better because the market of lenders is more competitive every day. So and they're going more specialized in some cases for wholesale businesses, for FBA businesses, for Shopify businesses. So I would strongly recommend to just go look for yourself, book a discovery call, and then try to build your own growth capital strategy out of that.
As a precursor, would it be fair to say that step number one, make sure you got your profitability calculations done accurately? Your books are up to date, you got a proper accrual set of books, your cost of goods are calculated on proper landed cost. You know what your margins are. You then, I think the big one for me is, it's not just about APR, it's about timing your cash flows. So build out your cash flow for at least 12 months. Even a simplified cash flow will work. And then when they come to actually look at the different options, they're going and picking based on what their needs are, because they first analyze what their needs are. Versus, I think the term you used earlier was the imposter syndrome, where guys are just chasing revenue and all they're doing is running after short-term cash flow fixes, but they might be acting like imposters and wiping out future profitability by doing so. A lot of wisdom from this place. I'm definitely going to include a link to TurboDash in the below the video. And Blaise, I'm excited to see where TurboDash goes as you start integrating with bookkeepers and accountants and partners and making this more available. I really, really believe the access or democratization of the space is what will allow people to really get the most value. Because it's been heartbreaking. Me personally, I've worked with over 200 sellers in this space, and your stat's correct, right? I would say more than 70% have accessed this funding, but now I'm making up a stat, but I would say less than half of them have had a good experience with growth funding.
And they consider, and after all of this, without going deep dive into this field, they are calling them loan sharks. Of course, there are some on the market, but they're like on every market, like on the PPC spends and like PPC tools, we can call them as well if they're gonna charge you 5%. But if you don't know that there are some others that will fulfill your needs, you need to compare them differently, right?
Exactly. And you need to be looking at the ones that are built to fund your needs, right? If you're going in wanting to factor a big box retailer purchase order, well, someone who's coming in and making you an offer based on your Amazon FBA sales is not going to be a good fit. So matching that up and having a tool, an intermediary tool like TurboDash will be super useful. So I'm excited to see where that grows. And the more that people buy in and use it, the more your data will be better and the better your allocations will be. So, Blaise, you're onto something very special here, and I look forward to seeing how this all pans out. And I'm looking forward to talking more and seeing you grow, but the industry grow as a whole. I think you're doing something very powerful, and I do think that you will have competitors over the next kind of 2 years, right? So it's good to be first to market. And please, guys, if you are looking into the space, map your needs, but then go look at 20, 30 offers. Don't go look at the first 2 that come across your desk, because there is so much admin to complete an application. With TurboDash, you don't need to do only 2 or 3. You can do 20, 30 applications. And Blaise, thanks so much for your time and for what you're doing. I think it's highly valuable.
Thanks for being here. Thanks for your support, Richard. Well, we will see what is what will happen to the market. We're in the very, very difficult time right now. So leveraging those aspects might be beneficial for the next years for sure.
Absolutely agreed. Thanks again, Blaise, and I'm looking forward to a whole bunch of people watching this and coming through to TurboDash and giving us some feedback. Great. Have a good one. Thank you so much.
Thanks. Bye.
Yes.